Hello? Yeah, how are you? I hope you're doing well wherever you're watching us from. I want to thank you for keeping it with us, but also continuously watching our videos. And I want to implore you to hit the subscription button, but also like our videos and share them to your colleagues for us to understand these concepts together. So now, a lot of people have been confronting my inbox asking me about the distinction between deferred revenue and accrued revenue. And today I want to give out the distinction between these two terms, but also the accounting treatment of both. Now, the deferred revenue is revenue that you received before you earned it. Literally, yeah, you receive money that you have not yet worked for. That is deferred revenue. Whereas accrued income is the money earned before receiving it. So you work for the money after working for it, and then you wait for the payment. So literally, you have worked for it, but you have not yet received it. So deferred revenue, or the money you received before earning it, is a liability. Because if you have received, let's assume 10 millions, and you haven't worked for it, it means you have a liability, you have a debt, and you can only pay this debt by doing the work. On the other side, accrued income is an asset. Because if you work and the people you're working for have not yet paid you, it means you have a receivable. And in accounting, a receivable is a current asset. Now, how do you recognize the two? The deferred revenue keeps deferred or keeps as a liability until you do the job, until performance obligation is satisfied. And on the other side, it is recorded as revenue, and you record when revenue is earned, not necessarily waiting for you to receive money and then record revenue. But a core basis says that you should recognize revenue, not necessarily when cash exchanges hands, but provided there is a right to receive it. And this is what happens. The accounting criteria when you receive money, before earning it, you debit the cash because cash has increased, and you credit deferred revenue. Deferred revenue is a liability, and by the time you prepare the financial statements, it should appear in the balance sheet as a current liability. Then on the other side of accrued income, when you make money but you earn it but you have not received it, what you do, you debit accrued income. Accrued income is an asset. It must appear in the balance sheet as a current asset. But also credit revenue, though you have not received the cash, but you have the right to recognize revenue based on accrual. So that is how I can differentiate the two. So I think those who have been inboxing me asking me about the distinction between these two terms can now stand to also attempt it. Now, if for example, you can take an example. If for example you receive, let's assume 10 millions, and this money must be spread, let's assume maybe you received rent, you have property and you received rent for a full year. The tenants have paid for 12 months. So meaning at the beginning of the first month, you have a liability, you have deferred revenue. The tenants have not yet utilized the rent they paid you or the house, but you receive the money, meaning you have a liability. So now the other person, the other tenant who paid you before trying the house, it means that he has an asset. He has an accrued and that one is the prepaid expense. But we are looking at a scenario where, for example, this tenant can apply the house, but she has not yet paid, meaning you have accrued income. There is income that has accumulated, but for the past period. So now the financial impact of these two, the deferred revenue delays the recognition of income in the financial statements, and the accrued income accelerates the recognition of income in the financial statements. If you find this video useful, kindly hit the subscription button such that whenever we share the video here, you are among the first people to receive the link or to receive the notification by YouTube. Thank you so much, and may God bless you.